Hey, what is going on, everyone? Today we are talking endgame strategy. So, what do I mean by endgame? I'm not talking Avengers. Unfortunately. But what I do want to talk about is what to do once you're an established investor, or what that even means. Because that might differ from your opinion and my opinion, but what they might have in common would be that we're invested in companies that we want to be in long term, no matter how expensive they are. But two, we have enough shares to do what we want to do. And what I want to do, and what a lot of the big players in the game do, is sell covered calls. Because this strategy is literally guaranteed to make you money. Now, I'm not a financial advisor. Please do whatever you want in your own risk. Okay, whatever. But it's like I said, it's literally guaranteed to make you money. So the only drawback would be opportunity cost. So I'll get that in a second. But sit back, relax, and let me just tell you why exactly it takes money to make money in this game. The covered call is an options trading strategy. Alright, so options trading, if you've never heard of it or just really don't know anything about it, I'm just going to briefly explain it real quick. But it is the more gambly side of investing that there is, okay? So you're willing to make a contract with someone out there, whoever's going to buy this contract because we're selling. But you can buy or sell a call or a put, okay? A call is you implying that you think the stock is going to go up by a certain date. A put, think it's going to go down by a certain date, okay? So for this example, we're going to talk about ones that expire this week. If we come down here, the trading week will start on Monday and it will end on Friday the 14th. So that is why we are picking the expiration date of the 14th. The further out you go, there's more uncertainty. So we don't know if the stock's going to go up or down. There's just a lot more opportunity for the stock to move. So these contracts will be more expensive, okay? Now the price of the contract is shown right here. So it's kind of confusing if you've never seen this, but just a refresher for anyone who does know. This is the current stock price right now, $4.45, okay? Anything down here is considered in the money, which means that this price right here is going to be below what the current share price is. Anything above this line, which is above the current stock price, this is going to be considered out the money. So down here, at this point in time, right now, this would expire in the money, and you will have to follow the rules. If it expires out the money, you don't have to follow the rules, okay? What are the rules? Okay, so if we are doing a covered call for Apple that expires on August 14th, in a practical sense, this is what's happening, okay? We're gonna pick a price, and this is where the wiggle room is. I don't really want to sell my shares. So I'm gonna think that it's probably not likely that Apple's gonna go up 10%, 5 to 10% during this week, okay? This is just an example. So this is how you're gonna choose which one of these contracts to pick because there's so many, okay? But right now the current price is $445.49. If I multiply this times 1.07, so I'm picking a price 7% higher, that's going to give me a strike price of $476.67. All right. So if we find the contract closest to this, you can pick whichever one you want. But if I sell this call, I'm going to collect 100 times this. So I would collect $128. That $128 is mine, regardless of what happens. But the contract states that if Apple gets to $474.99, so it's below the price that we chose, that's it. We just keep the $128 and we keep our 100 shares and we move on. But say Apple gets to $476 or $475.01, even $475 even. What we have to do is we are selling our 100 shares at this price because this is the agreed upon price in the contract. So we still get to keep our $128 and we're selling them for $475 a share, okay? Now because this is a covered call, this is assuming that we already had 100 shares. And this is where it gets expensive. And this is why I said in the beginning, this is exactly why it takes money to make money in this space. So to have 100 shares of Apple, that would be, it would just multiply this current price of 1 times 100, $44,500. So a lot of us don't have that yet, and that's why this is the end game strategy. But in theory, the strategy goes, we pick a price that we don't think it's actually going to reach that week, just a little out of reach. If it does reach that price, we just wait for a correction, so we wait for it to drop a little bit, and we buy back in cheaper than we bought it for originally. Thirdly, say we did have to sell our 100 shares at $475, that price that we agreed upon, you could actually buy them back at $476 and still make a profit. Because remember, at the beginning we collected that $128. So if we pay at $1 more a share for those 100 shares, we still made a profit of 28 bucks, and we bought them back more expensive than we sold them for, which is wild. But it's just a really cool concept, honestly. And you're literally, it's impossible to lose money here. The only downfall, like I said, is that opportunity cost. And the opportunity cost in this example would be, say the price actually went up to $490, $500, whatever. They're buying that contract, they're buying the shares at $475, but the actual price would be at $500. So instead of just collecting the 128 up front or whatever, you could have actually just not done it and sold your 100 shares at $500 a piece instead of the collecting 128 up front and selling them for $475 a piece. So it does cap your gains a little bit if this stock just goes on a monster run during this week, which is super unlikely, but hey, that possibility is there, all right? So just keep that in mind. You didn't actually lose any money, you just made less than you could have, and that's what the opportunity cost is. So the reason I wanted to talk about Apple in this example is because they are doing a stock split coming up. It will be their 5th one in history, but basically they think the price per stock is getting too expensive, and they want more people to be able to afford their shares, which will inevitably drive the price up, okay? So right now it's $445 a share. They're doing 4-to-1 split, so this price is going to get cut in fourth, and that obviously makes it more affordable. So now, when we're doing this covered call example, and you need 100 shares, right now 100 shares of Apple is going to cost you $44,549, which is kind of outrageous. All of a sudden they do the stock split, and now it only costs you $11,131, which is a lot more affordable for a lot of people. Apple is obviously very intelligent and successful with a market cap at just shy of $2 trillion. So this is huge because in the US, while a lot of the brokerages offer fractional shares, overseas not all of them do. So this will make buying shares a lot easier and more accessible for some of the overseas markets. So take a look. Later this month is when the split is occurring. So if you have one, you will get gifted 3 additional shares, but the price will be cut into 1/4. All right. So that's about all I got for you today. If you've never heard of a covered call, now you know. If you've heard of it, but it never really enticed you, maybe I persuaded you a little bit that passive income, hey, that's just extra for you not doing that much. And you can do it on a weekly basis. So if $128 isn't that much to you, if you do it 4 times a month, that's like almost 600 bucks right there. So it does start to add up over time. I'm not telling you to do this, obviously, but if you do want to do the covered calls on Apple and you don't have any shares, you could buy 25 shares right now at the current price, so $445. It's going to come out to $11,137 bucks. You will be gifted 3 additional shares per one, so this will give you the 100 shares you would need of Apple if you wanted to start doing covered contracts on it. So take a look. Hope you guys have a good day, and I hope you guys invested your time and your money wisely today. I'll see you next time.